Good morning, everyone. I'm sorry I can't be with you today, but as you can see from behind me, if I'm stranded in London, at least it's sunny. Now, what I want to do is talk to you about two things today. First of all, to give you an update on the UK REIT and what has happened since 2007. And secondly, to look at the possibility of having a new pan-European investment vehicle, a UK REIT. Okay, so if we now move on to the presentation itself, this is the content of what I want to cover. I'd like to look at the UK and the impact of the credit crunch and what's happened since then. I want to look at the EU REIT, looking at a passport. That means that everybody understands what a REIT is in different countries. And finally, what the future shape of a REIT in the EU might look like. So let's look at the UK first and the credit crunch. These are the four topics I want to look at: the size of the UK REIT market, some recent initiatives taken by the UK government, changes to our tax law, the tax law rewrite, basically its simplification, and some potential developments on residential. So if we look at what happened with the UK REIT market, during 2007, there was a significant fall in value as a response to the general credit crunch. A lot of people who were investing in property were getting quite concerned about it. They perhaps thought they were overweight in property, and therefore what they did do was look to see where they could actually realise their investment. REITs were the best way to do this because REITs are actually pretty liquid investment because it's a question of trading shares on the market and not selling the underlying assets. So during 2007, the market's response was to sell up, with the result that values fell to something like 30% of what they were at the beginning of January 2007. However, since then things have got much better. We've seen prices increasing, and that's really because I think people have suddenly realised that there is a premium to investing in property and spreading your risk. So if you put your money into a REIT, which is spread across a number of portfolios, it's much better than just buying a single property. Also, the REITs have gone out to repair their balance sheets by taking on more cash from their shareholders through rights issues, and there were a significant number during 2009. I should think something like 60 or 70% of the REITs actually did raise money in the market. And what we're seeing now is they're using that money to pay down their borrowings, so their balance sheets are looking better, but there also is an appetite for portfolio growth. So REITs are becoming much more creative and adventurous. Their biggest problem at the moment, however, is there's not much in the way of stock out there until the banks in the UK release their real estate into the marketplace. So we're seeing a rise in REIT values, but at the moment the REIT market is worth about 22 billion, whereas at the beginning, back in 2007, or at its peak, it was probably nearer to 50 billion. So you can see it's still quite a dropping off. We do have some new joiners, including Handstein, and the expectation is that this is something which will continue to grow. Now, I mentioned earlier that there were some problems with people's balance sheets. The biggest problem was this loan to value. So people who'd say bought a portfolio for 100 million, geared it up at 70% loan to value, 70 million of debt, that's fine. But if the portfolio value fell from 100 to 70, then clearly in those circumstances, the value of the portfolio was such the loan to value was 100%. 100% gearing is not sustainable. And even though most could actually meet their interest obligations, the banks were pretty harsh about requiring them to do something to bridge that gap. And so what we found was that there were higher interest costs. In some cases, the banks actually required the investors to break their debt, and there were costs associated with that. Now, the thing about a UK REIT is it has a finance cost ratio. The income has to be at least 1.25 times the interest cost. Well, when you factor in the break costs, clearly a lot of those were actually going to break that ratio. With the result, there would be a double whammy. First of all, the banks would say, well, you know, you're badly geared, so we're going to charge you more interest. Then the revenue would say, well, you've broken your finance cost ratio, so actually we're going to charge you more tax. Now, to get around that, the government's been very helpful and says that in the context of hardship, if a group is in a position where they have breached their finance cost ratio, the government will actually allow them to do that without any penalty, so long as they can prove that there was a real commercial driver behind that and they're not playing games with their tax law. Also, the second thing the government has said, but it's been deferred by the current election, is that a REIT can actually make a distribution of its PID. Its PID is its property income distribution. That's essentially paying out rent. In the UK, there's a requirement to distribute 90% of rent, which is calculated as if it were taxable rent. So it's rent, less capital allowances, less interest costs. Previously, the government said only distributions in cash could be made. Now they're saying you can actually pay a stock dividend, which is it's kind of like a distribution. The recipient of that has to pay tax as if he had received a dividend, but there's less cash going out of the REIT. So from a REIT's perspective, it's pretty. Moving on and looking at what might happen from a tax law rewrite point of view, when the REIT legislation was put together, it was put together on the basis of a single company investing in property. There are no REITs which are single companies investing in property. They are all groups. So the government has recognised this and is now drafting it on the basis that they are groups. Previously, there was a series of legislation and regulations because the first draft of the legislation wasn't good enough. So there were lots and lots of add-ons. And the government said, OK, fine, let's just have one piece of legislation so you know that you go to one section for one particular thing rather than having to look in 4 or 5 different places. So that's really helpful. And finally, there's going to be new guidance issued because the current guidance ties back to all the regulations and legislation that exists. The final thing I want to talk to you today about in relation to REITs in the UK is that we're looking at the possibility of a residential REIT. One of the things the government really wanted REITs to deliver was new homes, more new homes for people in the UK. I've got some statistics there which have come out of some research work which the government's actually undertaken itself. But from that you can see that we need about 300,000 housing starts per annum. At the moment, the current housing starts are less than 100,000 per annum. That's a big gap. And they're looking at a significant increase in new homes required by 2016. And this is the only way that the government thinks it can happen, is by getting you and me and institutions and companies to invest via REITs in UK residential property. You've probably heard about buy-to-let. That was a way where individuals went out, borrowed money and invested it in property. Well, that worked very well until the credit crunch. And at that point, most people, a lot of people anyway, got out of their mortgages. One of two ways. Either they found some way of selling the property, if they weren't highly geared, or the bank took the property away from them. And the feeling is that over the next few years, that buy-to-let market's going to unwind. So what's the government going to do about it? What it's doing at the moment is having consultation with the UK property industry, and I've been at meetings with the Treasury, and we've had discussions about what might happen to actually improve the way that the REIT world works for residential. There are a lot of problems which I've identified here. For example, if an individual goes and buys a house for £250,000, he doesn't have to pay any stamp duty at the moment. But if he buys 4 houses at £250,000 each, then at that point it'll go up to 5% because you look at the aggregation of the values of properties. So what the industry is looking to do is to go back to government and say these are some of the things that need to be resolved. So don't aggregate the upfront transfer taxes. If a property is purchased or a series of properties are purchased and their value is greater than £1 million and the tax rate is 5%, but each of them is less than the entry point, which is £250,000, there shouldn't be any transfer tax. The cost of repairs in the UK, it's the standard rate of VAT, which is 17.5%, and on that basis, any repair work becomes very expensive. All of this is reducing the yield. Our commercial property benefits from tax depreciation capital allowances, whereas we don't get the same for homes and flats. And if you look at the average yield on a residential rented property, it's about 3 to 4%, whereas 6-7% is quite the norm for commercial property. So what the government's got to do, this is what the industry is saying, is think about reducing the upfront cost, and giving the ability to increase the returns over time. And VAT, transfer taxes, the ability to claim tax depreciation, all of those will help. There's still going to be a yield gap, and the intention is that that could be filled by letting the residential REIT sell a few of its properties each year. Now, there are different ideas on what the safe harbour might be, but I think the point is that if we can get the government to accept selling just a small part of a portfolio, say up to 20% per annum, or not selling properties until they've been held for at least 3 years, that would be extremely helpful. And we'd end up then with a workable income stream that would be attractive to an investor. And that would be really important about moving forward institutional and private sector investment in the residential sector. That's the UK. I'd now like to move on and just talk to you about the EU REIT. The EU REIT is quite an interesting concept. I do a lot of work with funds, and it's quite normal to have a pan-European investment vehicle which enables people from different jurisdictions to invest in property in different countries within the EU. But it doesn't work for REITs at the moment. And I think people have recognised this for a while. So back in 2006, the industry started thinking about what might be done about this, and a report was commissioned. It was presented to the EU Commission, and they said, well, that's fine, but actually we want to hear some more data, just how might it work. And the consequence of that was a report that came out of the European Property Federation about a year or so ago, and I know too that EPRA is also looking at. As Joachim Ribeiro said, the property industry is like the EU. It's transformed itself, but it's got a lot to do to actually work more effectively. And this is where the EU REIT could come in. There's some statistics which follow. For example, if you've got lower levels of debt, which is generally the case with REITs because of the penalties which we've just discussed, for example, in the UK, that gives better security for investors. They are technically less exposed to the effect of the debt crisis. They fell off the cliff at the beginning, but they've recovered perhaps more quickly than some other forms of investment in property. They've also been quite useful in bridging the yield gap, so some slides here that show that. And if you look at the way the cash flows have worked to German open-ended funds, if you can have a passport, that would only improve things. And by passport, I think I mean something where the standards to which a particular vehicle is subject is something which is understood throughout the EU. And therefore, there's no question of, well, I'm not quite sure what this means. It's something which is, well, yes, we do understand how it works. We have some confidence in that. Therefore, we're prepared to invest our money. And as you've seen, there was some commentary about the problem with illiquidity. And the issue is that if you have an open-ended fund and there's a problem with its financing, you've got to sell the portfolio. Whereas if you don't like a REIT, you can just sell the shares. And as I've already said, that was borne out pretty well, certainly in the UK REIT market back in 2007. There's some individual REIT initiatives going on. Here's some slides going back to what's happened in 2007. In 2008, we've had Finland and Spain, and I think the view is that there will be more REITs coming along. I note, by the way, that, for example, Greece has had a REIT since 1999. Okay, so if I can summarise what I've said so far, why do we need an EU REIT? Well, we want it to enable pan-European investment. We want it to spread risk. The idea is that smaller investors can access a wider portfolio. If you've got 250 million in your back pocket, be it euros or pounds, you can go and start investing quite nicely in property, and you can pick a number of countries that you can do that. But the average individual investor hasn't got that kind of cash. But if they buy an interest in an EU REIT, then that would give them a chance to get access to property in Germany, Spain, France, whatever. The thought is that there might be niche players. We've certainly seen that in the US, where there is you can have a hotel REIT, you can have a residential REIT, you can have an industrial REIT. And the thought is that because the size of the property market in each jurisdiction is small, the chances are that there isn't the ability to have a niche play, whereas if you take the States, for example, it's a much bigger market. Well, the idea would be that you could replicate something like that in the EU. I think the other thing is that clearly there are more REITs out there, there's less distortion in terms of competition, and if there are certain things which are similar in each REIT, then people will understand it more. And of course, the benefit of that is that if they feel comfortable and if generally they can get their cash out without suffering tax, why would they want to go to a tax haven? So why isn't there an EU REIT at the moment? Because everything I've said does make sense. Well, there are some things which are very similar in EU REITs, and here they are. They're listed, they're accessible to smaller investors, generally they're regulated, they're probably reporting under IFRS or a GAAP which is pretty similar to UK GAAP. It's for long-term investment, it's income distributing, and generally it's tax transparent. But there are some crucial barriers. The REIT regime in each territory differs, and I'm going to show you a comparison for 3 countries in a minute. The problem is that if you have REIT owning REIT, so you have a tiered layer of ownership, what you end up with is a tiered layer of tax, such that at the end of it, it's not worth the effort. So some steps have got to be taken if we really do want the REIT to invest across the EU. I'm not going to go through all these issues, and they'll be in your slide pack you can see afterwards, but cast your eye down there, just go to the bottom. Let's just look at withholding taxes, for example. Well, if you're a resident or you're a foreign owner in Belgium, it can be the difference between 15% and 0% of withholding tax. In France, it's 25%, but you might benefit from the parent subsidiary directive. In the UK, it's 20%. For overseas individuals, it's definitely 20%. And if those individuals are in a treaty country, it could be anything from 15% down to 0. So it's very difficult to see how you can argue that these things in Belgium, France and the UK are very similar. They're similar, but they're definitely not the same, and that's the crucial difference. So, in the US, they took steps to make sure that everyone investing in the US via a REIT was subject to the same amount of withholding tax. And the OECD supports that, and there are models out there. But that means, certainly from a UK perspective, that each OECD model treaty would have to be renegotiated, and they can do as they come up, but it's going to take a heck of a long time. So it's something that needs to happen sort of more at REIT level, EU level, rather than at treaty level. I think I've covered this slide really looking at the commentary in Article 10, but for those of you who are keen to look at the OECD model, it's basically saying there should be a portfolio rate of 15%, and if you have an interest which is significant, say 10% or more, it'll be a higher rate. But as I've said already, it's bilateral, it's got to be negotiated. I want to take you through an example now. This is purely illustrative. The numbers are kind of right at the moment, but as each law changes in each country, the numbers may turn out to be different. So what I want you to do is to see this example purely as an illustration of how a layer of tax means that currently an EU REIT doesn't work. So let's just focus on a property that costs 100 million euros. Its location is Spain and its yield is 10%. And the property is owned by a UK REIT. The French SIIC has an investment in the UK REIT, and you've got a corporate investor in the French SIIC. So you've got a whole layer of different investors in this property based in Spain. Well, you start from the bottom, so it's in Spain, so it's actually going to pay some tax because it's based in Spain, and Spain levies tax on property, as indeed does the UK, so no surprises there. Okay, so we've seen the position in Spain. If you look at the right-hand side, you can see we've suffered 2.5 million euros of tax already in Spain. We'd gross it up and we'd expense it, and we'd end up with expensing the Spanish tax because there's nothing else we can do with it from a UK perspective, because we're looking at this as property owned by the UK company. It therefore is required to distribute 90% of its rental income that it's receiving, but it suffered tax in Spain, so it can only distribute the cash it's got. So I've expensed it in the calculation. However, if the UK REIT is going to distribute outside the UK, it's got to withhold tax of 20%, which you can see is the 1.5 million. And therefore, there's going to be 1.5 million of withholding tax. So where we end up with is Spanish tax already suffered of 2.5 million euros, plus we're going to have UK withholding tax of another 1.5 million. So far we've suffered 4 million of tax. We come to France, we look at the French REIC. They'd look at this on a look-through position, and so therefore there would be no further tax to pay in France. But then we look at the corporate, and it's had a distribution, so it's actually going to now suffer tax at 34.43%, and therefore it's going to have French tax. So if you can see the total on the right-hand side, we had the Spanish tax, there's no treaty relief, we have the UK withholding tax on the REIT, and now we have the local French tax. So we started off with 10 million euros of income, and we've paid away 6 million of euros to various jurisdictions. So on that basis, the EU REIT just doesn't work at the moment. So something has to change. So what might we do about it? We're going to come to that at the end, but let's just look at the regulatory issues before we come on to back to the tax figures. There has to be some kind of standard regulatory framework, something that everybody understands, so that in country A it's not one thing and in country B it's not something else. Also, the level of regulation has to be such that it's acceptable to everybody, otherwise why would you set a REIT up in that place in the first place? So it's something that everybody's got to subscribe for. Now, you know, there's going to be some improved regulation given the recent credit crunch, and I'm going to come on to something in a minute which really focuses on that. But for everyone, there needs to be some transparency and some simplification about how the regulatory framework will work for each participating member in the EU REIT. Here are some current passports. There's the UCITS, which is well known and understood. There's the OREFs for the open-ended real estate funds. We need something for the EU REIT. And here are some crucial barriers on regulation. For REITs at the moment, there's no standard regulation. For UCITS, it's based on the local country standard. And we've got OREFs, which have now been brought into play, but they're for open-ended real estate funds, whereas clearly, generally speaking, a REIT will be close-ended. The latest development, which might be helpful to an EU REIT, is the Alternative Investment Fund Managers Directive. I think in most countries there is a concern about the way that this is being brought to bear, but as I understand it, and I know it's a moving feast at the moment, this is a form of regulation that requires certain things like custodians, regulated managers be put in place, and it's something which is going to work across the EU. I think the biggest concern that there is about this AIFMD is that it seems at the moment that only vehicles which are actually subject to this regulation can be marketed within the EU, which is fine, but the difficulty is that there are a lot of people that are marketing funds in the EU who are based outside the EU, including, for example, the US. And I think the United States of America is going to be quite upset, and I think already we've seen some commentary back from the EU that this is not supposed to be anti-competitive. So I think the point is, from a regulatory point of view, we need to watch how the AIFMD develops, but that might well be very helpful, at least in terms of the passport for an EU REIT. So what might the EU REIT look like in the future? I think it needs a number of attributes. It needs to look the same in each territory. The tax has got to be basically the same. There are different ways that you could look at it, but we want the flow-through principle, and this is something that the European Property Federation was suggesting might work, which is you basically let the base country, the first country where the property stands, take the tax, and then everybody else just flows that tax through, so there's no further tax to pay. And we want a regulatory framework which is common to all REITs. So I think what we want tax due at the moment of profit distribution by the REIT. We don't want any withholding tax levied when that REIT makes its distribution, so we can get rid of that levy charge that you saw earlier in the calculations. We want a withholding tax which is kind of recognises the fact that the local country in which the property is situated is the one that should get the benefit of the tax. But all these points have got to be agreed in principle, and then there's got to be work on the detail. There are different ways of looking at how this might work. We can either have a final tax which applies to the shareholders of the REIT, or there's some kind of credit against the personal income tax of the shareholders of the REIT. Or we have some kind of flow-through principle where essentially the tax which is levied by the country in which the property sits goes right the way through, so there's only ever one level of tax. Now, there's going to be a problem because clearly where there are tax-exempt entities, that is not going to work for them because they're going to be subject to tax, and clearly if they're tax-exempt they won't want this. So for any pension fund, for example, there has to be some change. So the thought process is that the country in which the property is situated will collect the tax, but there will be some kind of mutual system of refund so that that tax does not become sticking tax, but it will have to require all the members of the EU to agree to that. And the second thing is that if there's going to be a sale of shares in a REIT subsidiary, in those circumstances also for tax-exempt entities, then there's not going to be a tax levy. Now, that's quite a lot of discussion that would have to go on in order to achieve that. In summary, it's a big challenge to bring in an EU REIT that works effectively in every country. What it will require is, first, that each country is willing to share the tax that is going to be levied in at least one place, probably where the property is situated to begin with. And secondly, I think the AFIMD will be very helpful in providing a framework in which the EU REIT can sit, but that will only work if all the different jurisdictions can agree on how to share the tax that will arise from investment in property without the current position we have where the tax cost is so high that no one's going to invest in a pan-EU REIT. At this point, normally in a presentation, I would ask for questions, and clearly that's not possible. However, at the beginning of my slide pack, which will be available to you, I do actually give an email address. So if you do have any questions, do not hesitate to send me an email. And just to finish off, you've had quite a lot to listen to today, and I'm sorry I can't be there, but I hope you found it useful. So thank you very much for listening.